We can't hear you, Bobby, or at least I can't.
I can't hear him either.
Sorry about that. The Georgia Department of Revenue says I don't have a farm for some reason, so I just deleted my farm, but I had to kill my darn rooster because he was so hurt. Unbelievable, just unbelievable. We had him 3 years. That was the meanest darn thing. I can't imagine what would have got him, right? So the only thing is, we got 19 chickens the other day, silkies, and we're down to 2. I think my pigs are eating chicken. Now, my pigs are mini pigs though. So, we've never seen them aggressive toward them, but I don't know. I just got a feeling, when a pig probably gets a taste of blood, then they're like going after my chickens. So now I'm down to 3 chickens total from I just had 22 like 2 weeks ago. Now we're down to 3. Unbelievable. Why not even try? Beth, you got a Band-Aid? I cut my finger some way. Probably need a tetanus shot. Oh Lord, that hurts. Just from my finger. It just kind of hurts. Huh? Yeah. That's never easy. I'm glad the kids wasn't here to have to witness all that stuff. Unbelievable. Anyway, life on the little farm, I guess. So take me a while to get over my chicken, y'all. I mean, I love my chicken. That's the thing. And I know he was mean, but he was the protector of everybody else too, Well, until the new chickens came, and then that rooster kind of became the boss, and he's a little boss too, but he's not mean toward us. So at least now the kids can go into pasture without being terrorized by the rooster. Let me get a Band-Aid on before I can type anything, y'all. This is painful. I don't know what I did. So we had to go scoop him out of the barn. It's just sad seeing him,
When used to him attacking.
Oh yeah, he's so majestic, and you can't imagine anything. But put that on my finger. I'm not
What I was gonna do, and then you took it from him.
Put that on my finger. And Al got one of your son's chickens. Yeah, we got buzzards around. We got coyotes. We
I've
got
been seeing a lot of hawks too,
hawks.
so.
I don't know. Something got a hold of him. Bless his heart. He just didn't look good in the barn.
But I've
when we
seen
were
the
feeding
other
him.
chickens. I don't think it was the pig, because there's nothing out there.
Well, I hope it's not big, but I got to figure out, what's
I don't
happening.
think it is.
We're gonna have to. I mean, we bought a brand new fence 2 or 3 years ago, and I don't know, man. I don't know. It's just very discouraging. I love my chicken. All right, so what's the market doing? Oh my gosh, down 1.3%. What was it down? 1.8% yesterday. So our account probably blew out, right? So we're down 1.8 plus 2.8, 3.1% in 2 days. So there's probably no need for us to even have a session because our account is probably down to 0, but we'll see. Let's see how bad we are. So let's go do the Tasty Works first. Unbelievable. Oh, that's the part of having animals, y'all. You get attached to them, and then next thing you know, they're gone. And he was a good rooster in his own little way. All right. I'm gonna not be all together here for a second. Just give me a while to get my devices back. Let's see. Where I won't show my stuff. Plus, it was personal trainer day today, which 3703-478. 3703-478. You'll help me remember that. 3703-478. 37. So we didn't blow our account out. 3703-478. 37. Oh crap. 3703-4.78. Bobby, wait a minute. The market's down 1.3%. And you're down $30. Wow, look at you. We're the stuff of champions. I like that. So what a resilient little portfolio, but no Jeffersons. Let's go get our Crimson account. See how we're doing over here. Crimson is, who's calling me? Dang it, probably somebody from Mableton, Georgia. Probably bill collector. Oh, there's a picture of my rooster. Unbelievable. All right, let's see what we got here. Netlick and day trade. So we are at 27. Oh, not as much as yesterday. 27,598. 27,598. Let's go over here. 27,598. At least this will pep me up a little bit. I get to play the Jeffersons. So we made.
Well, we're moving on now. To the east side. To a deluxe apartment in the sky.
I give up my $14 to have my little chicken back, to be honest with you. All right, so let's get our Greeks and ratios. Oh, I didn't get the Greeks and ratios from the other account, did I? Let's go with Tasty account. Again, I'm not all there because of the traumatic events that just transpired at Gaines Manor. All right, so we're at 30 and 73. 30 and 73. I said we're at 30 and 73. Appreciate everybody that joined us last night. We had a late night session. Look at there, our VIX should be 20, and so we're good there. We're good there on deltas, and let's put in our buying power. Buying power should be fine too. So we're at 15,226. It's a little high. 15,226. Okay. So we're at 41%. Am I comfortable with that? Yeah, probably so. My theta's fine. Everything's good. And remember, I have this. Thank you, Candy. I appreciate that. I have a hypothesis. And the hypothesis is we could probably run this thing at 50% all the time. I don't want y'all to do that. Let me be the experimenter on that. That's just a hypothesis. I don't know. We need to be tested, right? We need a big 10% down move or 15% down move to see, what happens. So that's my hypothesis. So I'm perfectly comfortable. Now, if you're not, here's what you could do. What I would suggest you do is go to the nearest expiration, right? This is my 10 days. And you can close some stuff, right? So here we have 97% profitable on these two puts. You could close those, right? With 10 days left. You could close these two here at 97.6, take your profits. If you need more theta, you could go farther out in time. So the total theta on my 10-day options is, well, that's not on my 10 days, but my total options, yeah, it is on my 10 days. Let's see, but yeah, that's all my 10 days. Total theta is 9.741. So I could actually take off all these shorts, right? These naked ones. I could start going into the put debit spreads and taking off the short part of those that are really profitable. And then what you could do is replace that risk and that theta, if you wanted to put the theta out, and do it at 60 days. No problem with that whatsoever. I personally am comfortable with the risk, so I'm not going to do anything. I'm just good. All right, so let's do our Greeks and ratios on our little margin account. So over here, little Bob, we are, remember, don't count your little T-bills it's got to see. So right here, we're at 13 delta and 38 theta, 1338. Let's put that in. 13, that tells me the market went down. 38. And our buying power, are we out of control over it? Let's see. Buying power is 11,625. 11,625. Okay.
Hey, Bobby, I don't know if it makes a difference, but I have a VIX of 22.
Oh, really? Okay, let's see. Yeah, it won't make a difference on our thing, but let's see. Let's hit that. Come on, baby, work. Work. There it goes. Yeah, it works. It works. Then remember, you got to put it in manually after you do it, right? So 22, everything stays the same. So theta, we're half throttle. Our deltas are non-existent. And we're a little over buying power. Again, what could you do? Y'all know the drill. If you're not comfortable, close something. And might as well close something that's profitable. So go up here. Look at these 10-day options. Look, 97, 97, 97%, 97%. Got no problem. If you want to close those, go at it. Again, why do I not? The reason I don't is because if I go to the trade tab, watch how safe these are. Then I go to the 10-day options. And I'll show you the delta on them, the probability of being in the money. So we go see those 10-day options. Let's look at them. So here's where they are. The probability of that ending in the money is 0.29%. I have a 99.71% probability that that booger right there is going to expire worthless. Why expend the money and the effort to close it? I just don't see it. Your comfort level, y'all. We got a lot of discretion with our little plan here. So there's nothing for me to do. Also, I'm not putting on another trade either, right? Even though I say I could go to 50%, I'm going to throttle it down, throttle my risk down. My theta's fine. I got enough to drive the car and no reason to do anything. Just sit. Just sit, Bobby. Let old Theta do its thing. So let's go to the final account. Go to the final account, the IRA. Bobby, you can do this in the IRA. Yeah, isn't that cool? All right, let's see. This one is at 105,947. Dang it, we ain't gonna get to play it, I don't think. 105,947. 105,947. Darn it, we lost $30. 105,947. Crap. I wanted to play the Jeffersons. 12, 6, 22. That's our correction rate. So we lost $30 in this account. No big to do. Go back and get our correction ratios. And remember, don't count your T bills. So we are at 51 delta and 116. 51, 116. 51, 116. Look at that. I'm gonna be more than 0.1. Look at me. I didn't do anything. Remember last night I was gonna put on trade and I said, I'll do it tomorrow, but now I don't have to. Let's get our VIX fixed. Let's fix our VIX. There she's 22. So we type in 22 after we get it. And then we use our buying pair usage. Buying pair 42,324. 42,324. And it's fun. Looks like they pumped up our buying power a little bit. Okay, so we're at 39%. Deltas are fine. This is fine. How come that isn't green? I thought that's supposed to turn green. Doesn't it on my other spreadsheet? What the fix that? But on the Sweet Bobby spreadsheet, it turns green. How come it doesn't turn green there? Does it turn green on this spreadsheet? Yes, it turns green on this spreadsheet. Why did it turn? No, it doesn't turn green on this spreadsheet. Okay, I gotta fix it. I want it all to be the same. All right, so what do you do today? We don't do anything. We let what was Dr. Jim? What did he call it? The decay of premium or the sale of premium, whatever he said the other day. It was so eloquent. And it's like Stacy said, Bobby, you say the same thing. You say put on the name trade. That's what we do in all markets. Selling premium works, y'all. So everything looking really, really good. So let's go and let's look at our little stats. Let's brag a little bit. Let's go to the IRA and let's see how we're doing. So now this has got the brand new spreadsheet on it. If you don't have the brand new spreadsheet, it'd be in the Muscadine Mafia where you can get a copy there. Let's go to our realized returns. So we have made, you got to know when to hold them, know when to fold them. We have made $8,640 on this strategy this year, which I would say is pretty darn good for a year where the market's down, what, 16, 17%. Now, since we started this, we're only up 4.19%. And you say, Bobby, why? Well, y'all know because we did all those stupid trades. But with the 111 and 112s, this was the ideal thing. This includes dumb trades that we did as well. So even so, though, we are kicking it, y'all. Look at us. Let's refresh it. The market is down 11.73%. We're at 4.19%. This is beautiful. Then you get to come over here and you get to see the fruits of your labor, right? So now, y'all, December ain't working too good. We're 6 days in. We've only sold $125 worth of premium. That's fine. Now, we're going to let premium decay. We'll sell some more. But remember in our last night's session, how we were talking about, you can kind of figure out what your monthly returns will be in a bullish type market. So in a bullish type market, you should keep 100% of the premium that you sell. In a bullish market, you should keep 2,700, 1,900. So if you take 2,700 and you take what your account balance is, that should give you some indication of how much money you're going to make in your account. We found out yesterday that if we made 2,700, let's do it again. So y'all that missed it last night, because it's kind of fun to look at, right? In the daydream, because you can start daydreaming about night things in the middle of the afternoon. 2706 divided by what we started with, 98,904, is going to be 2.73%. Now you say, Bobby, man, that ain't too good. 2.73%, y'all ain't good. Now let me tell you something. You are among the elite portfolio managers in the world. If we can make 2.73% a month times 12, y'all, we would be pulling in 32%. Do you realize how wonderful that is? Now, no, it's not the FOMO and the YOLO and the HOLO of Wall Street bets and, making $1 million in a day like some of those people do, and then they lose it all the next week. So it doesn't get your adrenaline running. But let me tell you something. If you can make 20 to 32% on your portfolio, a year, you are going to be doing dang good. Well, you say, Bobby, what if it's not a bull market? Okay, what if it's a bear market? Bring on the bear market, baby. Let's go see the bear market. All right. So let's see what it looks like. So let's go here. And you say, okay, Bobby's going to be a bear market. Let's bring it on, baby. Because here is us making that money on the bull market. See that? See how it green and the green don't go up. It's just green, green, green. Oh, the green, green grass of home, y'all just keeps going up and going up. It doesn't matter how bullish the market is. Now, what if the market pulls back? Well, it stays green. This is one standard deviation in the next 10 days. What if it falls 2 standard deviations? I say bring it. Because now what we were making at expiration, $687, if we go down to 2 standard deviation move down, we're going to make $801. So what if the market goes all the way down here to $32.50? You're going to make, instead of your $600, we're going to make $3,437.50. I mean, y'all, we're actually able to have our cake and eat it too. You want a bull market. Bull markets are going to be going on probably 80% of the time. That's fine. We'll get to keep all the premium that we sell. But what happens if we have a pullback? We know exactly what happens. We make mucho money. This is where you say, hey, you know what? I'm going out to the AMC theater tonight and we're going to watch a Disney flick or you're going to watch, you know, what's, I don't know, Tom Cruise movie or something. And you go, you know what? By gosh, tonight we're going to get the popcorn with extra butter. And then your spouse will look at you and say, we don't ever get the popcorn. We always smuggle in the candy from Dollar General. That's what we do. We go to Dollar General first. We smuggle in all the candy. Beth looks like she's pregnant. She's got so many pockets filled with food. And that's what we do. But now, when you come down, you know, this far, right, 3,200, 3,300, you celebrate because you and I get popcorn money at the movie. This is where, you know, you go out with your relatives around Christmas time to a restaurant, and y'all know how it is. They think y'all got the money, and they're looking at y'all to pay for the bill. And you're like, I ain't paying for the bill for all these hillbillies gathered around the Cracker Barrel table. Are you kidding? Separate checks, please. That's the first thing I always do. Separate checks. I ain't buying all this. But then when you have a pullback, you'd be like, you know what? I think I'm going to buy Billy Bob's food over there. Yeah, put it all on mine. Put them on my bill when you have a pullback. So we have our cake and eat it too. We want a bull market because we are Americans, baby. We want the S&P 500, the 500 greatest companies in the country to excel. But when they don't, we are willing to take the profits. Now, what happens here? Here's what y'all are worried about. And some of you live in this fear. You live here and you are not satisfied. Matter of fact, you are terrified of what happens down here. Y'all, you can't live in fear. You can't live in fear. You can't live in thinking, what happens if this happens? Okay, so if this happens, what do we do? Let's go through it one more. It is a big wheel, John. It's a really big wheel. So let's talk about what we do. Let's talk about how we manage the unthinkable, the nuclear war, the calamity, the COVID or the next COVID or whatever it is that comes along. There's always going to be something. There's always going to be 9/11s. There's always going to be World War I's and World War II's. There will be a World War III. Y'all know it's just a matter of time. There will always be wars and rumors of wars, as Matthew 24 tells us. There will be pestilences and diseases and all kinds of calamities that will compound the earth. So what happens in those times when this happens is we're going to get together and we're going to say, okay, first thing I need to do is neutralize my deltas. How would I neutralize my delta today if I had to? So if the market goes down, my deltas explode. So say that my deltas now are 500. Well, let's go. It's easier to see it on Thinkorswim. Let's go here. Let's get the big account. Let's see. Let's talk about calamities, right? Because we don't talk about them enough. So let's go calamity, single symbol. We're going to hide any simulation. So this is our stuff, right? Make sure we're showing all the series. Yeah. So here's our thing. So what happens in the event of a 20% down move? Okay, 20% down move, we got problems. Now all of a sudden your deltas that are 121 today, show them on the right day. Yep. Your 120 deltas today with a 20% down move go up to 1,482. Right? That's horrible. So what would you do? Well, first thing I would probably do to negate that is I would sell 2 ES futures. 1 ES futures gives me how many negative deltas? It gives me negative 500. To do 2 of those would give me negative 1,000. To do 3 of them would almost bring me delta neutral. So you get to sell 3 E-mini futures to get my, oh, that's my theta, sorry, my delta. Sorry, y'all. I'm on the wrong thing. Y'all scratch that. Just scratch everything I was saying. Y'all know I've lost a rooster. I had to kill him because he was so severely injured, and I am not doing good. My deltas are 284. So now what do I do? If I wanted to negate this and make it a non-factor, I could sell how many micro futures? 5 or 6. If I sold 6 micro futures, not options, that would give me negative 300 deltas. They give me slightly negative deltas. So we could do static deltas just to allow us time to think, right? Just to allow us a little time to think. So y'all know what we do there, right? So because look, your buying power effect goes from 42,000 now to 252,000. You can't stay here. If you stay here, Mr. Broker's going to pick up the phone and say, excuse me there, Dr. Gaines, you know what's going on? Your account is $100,000 and we're going to require 250. And this is even going to explode. This is even going to explode. Now, here's what's going to scare you, right? You say, okay, so 20% down move is here, Bobby. So you're saying we're going to be down $59,000 in a $100,000 account. No, friend, it's going to be worse than that because we got to add the effects of volatility upon that, right? And so when volatility, this is an approximation of what volatility would be. We call this VIX, right? And I know somebody's going to say, Bobby, this is not exactly VIX. I get it. It's implied volatility, but play along with me. We're going to pretend this is, we're going to kind of equate this to VIX. And I know that there are issues and problems with doing that, but we're just estimating. So if the VIX, if we go down 20% and the VIX pops up to 57, our $100,000 account is going to be down 124,000. If it goes up to 67, we're going to be down $139,000, y'all. That's terrible, right? So what do? So some of y'all right now are going to say, crap on this strategy, I'm out of here. And you're probably crapping out on something that may happen one day for the remainder of your lifetime. You're going to give up all this wonderful profits because you're scared to death. I got it. So we neutralize our delta, and then what are you and I going to do? We're going to go into our little positions right here, and we're going to roll, baby. We're going to roll them out, and we're going to put them in problem child status. We're going to go over here, and we're going to say, where's my problem children? And we're going to slowly but surely, we're going to roll stuff out. We're going to improve our metrics. We're going to improve our deltas. We're going to get more credit. We're going to give us more time. That's what we do. Now, is there a way that I could actually go through it right now and show you specifically how we're going to do it? Not that I know of. It's just that we'll do it together. You will see old Bobby rolling up, and Beth will say, Bobby, the rooster's bad. You're going to have to put him down. And I'm going to say, I can't right now, Beth. I just pray for it. And we got to roll stuff down. And that's when we'll do this together. But it may be, I'm 52. It may be that we'll see one of those, I don't know, one time in my lifetime. It may happen 2 times in my lifetime. It's not going to be that often. So you can't play for calamity. You can't play for calamity. When you're the University of Alabama and Nick Saban is working toward a 7-second play, he cannot, as much as he tries to control everything, he couldn't control the stadium crashing in and killing everybody in the stadium. Nick Saban can't play for that. That's not what he plays for. He goes there, he goes, I gotta trust that there's a good stadium, that the infrastructure that has been built here is going to be fine, it's going to be stable. But he can't play for, when he's playing his team, he can't play for a terrorist and a dirty bum in a stadium. That's what we're talking about. We're talking about mass calamity that causes us problems and issues. So you just can't play for that. Now, he calls and finds out the temperature in the Dome Stadium. He wants to know how the temperature will vary based on the number of people who are in the stadium, right? So that he knows about the inflation of the ball when it's going to be kicked by his punter and his place kicker. So that they can replicate that in practice. They can replicate the temperature based on the number of tickets sold, number of estimated people who's going to be in the stadium at game time. You see how you take every factor into consideration. He does not take into consideration a dirty bum or the stadium crashing in. You and I can't either. We can just say, what would we do? The first thing we would do is we would get our deltas kind of in order. The next thing we would do is we would roll out in time to improve our measures. Would we take losses at the moment? Yes, we would. Yes, we would. Would we survive? I believe that we would survive, especially now when the VIX is starting to become lower, right? You and I are now at the point of saying, okay, VIX is the only asset that reverts to its mean. So, right, we know this, it explodes, it goes down, it explodes, it goes down, it explodes, it goes down. So what would happen is we're down here now, right? We're down back in the close to the teens. It's popped up again today, close to 22. But you and I, as it starts getting down to 18, 17, and 16, this is where we start to kind of build in a few hedges. This is where we start to do that. Now, could we do it today? Oh, absolutely. We could start doing it today. Brett says, let's see, first step, sell or buy puts to neutralize delta. Yes, John, you can do that as well, right? So what we talked about, who was it the other day? Was it Mark that talked about buying the cheapest put that you can? Yeah, absolutely. Define your risk, get your buying power down. You can do that too. I didn't bring that up. My first thought is I'll go to the futures market, but yeah, you certainly can start buying little bitty, puts out there and taking that buying power down as well. So there's all kinds of things that we can do. And I just don't know of a way that I can show you what to do until we actually get to that point. So, but again, I can't play for that. I cannot play for that. Now, if you're playing for that and you're sitting there going, man, Bobby, that's scaring me to death. Okay, then here's what you do. Remember, here's what you do. Remember when we were at 98,000 in this account, right? We were at 98,000 back in the middle of October. Let's see where it was, October. We were at, okay, maybe it was, yeah, at the end of September, we were at $98,000. We're at $99,000. What are we today? We're 106,000, right? So we made $7,000 since the end of October. So what would you do? Okay, put that in cash, move it to another account, put that in T-bills, right? Whatever, move it into another account, get rid of it, get your account back down to $100,000, and then live on the income here. You know, get your accounts and get your income out, put it in save, put it in T-bills, put it in CDs, put it in whatever you want to put it in. Take your money out and then keep doing this, because what you'll soon find out is before long, your little $100,000 account will keep rolling like we're rolling. It's going to be $200,000 account. So then you take all your $200,000 out, put it in your T-bills and your CDs or whatever real estate, whatever you want to do, and enter cash, right? Say that you want to take mama to the Waffle House a few extra times. Take mama to the Waffle House, save you money, and then just keep trading with your 100,000, right? Well, Bobby, how much should I be making on my $100,000 account? Well, okay, little friend, I'll be making $116 a day. 79, 89 a day, 99 a day, whatever this number is. This is what we should be making a day. Okay, Bob. So let's go back to the realized returns. How much should I be making a month? This amount. Whatever you're selling, how much you ought to be making. Isn't that cool? Bobby, only December, you only gonna make $125. That's fine. I'm gonna make 27 here, 19 here, 125 here. And if the market goes down, I'm gonna make more than that. Y'all see how great this is? Let's go again, because a lot of y'all probably didn't get to see the thing that we did yesterday. So the thing is Tasty the only platform that shows that kind of view, i.e. the whale? No, the whale is also over here. It just ain't as pretty. Let me show it to you. So on the Tasty thing, I was only showing y'all let's go to one expiration here. And let's go to high simulations. I'm gonna just show y'all the 10-day stuff. There it is. There's the well over here. It ain't near as pretty. But in a raging bull market, y'all, I'm gonna keep $1,325. It don't matter if this goes up to infinity and beyond. But y'all, if we have a pullback of 5%, I'm still gonna keep $1,325. If we have a 12% pullback, I'm gonna make $3,800. If we have a 20% pullback on this first expiration, y'all gonna make $5,239. That in and of itself is a hedge against the remaining portfolio. This is just my 10-day options. Now do you see why I'm not closing the naked puts? Yeah, but Bobby, what if it's a 25? Okay, you're playing for the stadium to collapse. You're playing then for the dirty bomb. If you are a doomsdayer and you think the dirty bomb is going to come up and the stadium's going to collapse. And by the way, when we used to play at Legion Field in Birmingham, the Iron Bowl, there was a good probability that stadium was going to collapse, kill everybody. You know, I don't think they're playing it anymore. It's kind of dangerous. So Pat Dye said, let's get the crap out of here. Let's quit playing in Birmingham, giving Alabama an advantage. All them Alabama fans in Birmingham, let's do it at home and home, bring it to home. Bear Bryant was all pissed off, right? Pissed off. But I don't blame him. I got it out of that hellhole too in Birmingham. So, yeah.
But
Oh,
before
Evan's got
you
his hand up.
before you move out of this, I think this kind of gives us a chance to talk about kind of an interesting point. Can you go into your 10-day expirations? Well, I'm sorry, before you do that, can you take a note of where your hedge starts to kick in here?
Yeah, so my hedge kicks in
Right.
here, right here, right? So it's at the 35, let's say 35.80.
Okay. If you could go into your 10-day expirations and just pull off all of your short legs from the debit spreads and the naked short puts,
Yeah. let's do it.
because we'll kind of assume at this point that they've all hit 95% profit.
Yeah, so let's take off all the short ones, right?
Yeah, take off all
Yeah,
the
and,
shorts.
and what Evan's going to show you is, hey, Bob, you're going to get a great hedge for the next, what we say, 35.80. So let's take out all my negatives. Oh, Evan, I wanted to tell you something too. I don't know if you got to listen last night. I brought this up.
Yep, I did.
Tasty Trade last week had a segment on selling calls in a bull market. Did you see that?
I didn't see the segment on it, but I heard that you mentioned if they're less than 10 delta, they should be fairly safe.
Yeah,
Which
and
is
where
our
and
112s
that's
go.
about where the 112 would be. So you should be absolutely fine on that based on their research. So I wanted to share that with you since Evan is he's our guinea pig with the call. So, but it was kind of cool, right? The 16 delta did not make money. And think about it this too. You have something other than the 10 deltas. You've got that nice debit spread too, right? That's going to build up
Yep.
profit. So I think that should alleviate any concerns that you have with selling calls with, not that you had concerns to begin with. All right, so Evan wanted me to take off all my naked puts in the 10-day cycle, plus all of the short puts in the debit spreads. And I think I have done that. So let's go look at this little puppy here. Right? This is going to be fabulous 10-day hedge here. Look at this. So now look, y'all, it says here, right, that we're down $5,883. Right, so that's not correct because we've taken profits out of this other stuff. And this is, let's say one series, one series. So where does this thing start kicking in more? Let's say 46.79, 58. I mean, it starts kicking in kind of immediately. See this? So that's less than what this is. So there's a 5% down move. Then we start going down to a 12% down move, and we're up.
It's hard because it doesn't account for the profit that we took
Yeah.
on the short puts.
Hold on a
my
second.
whole
Let's do this.
point-
Here's what we could do. Instead of P&L on the open, let's change it to P&L on the day, right? That'll
There
look
we
much
go.
better. There we go. So now here we are at, we'll be up 2750. You go down here, you're up 1274 on the day, right? You go down 12%. We're up. Look at that, y'all. $9,682. You go down 20%, and we're up 34,000 there. So I mean, that's the, there's the gimmies and the gotchas, as Dr. Jim tells us. And yeah, if you want a nice 10-day hedge, you could close all that stuff. What would I then do?
So
I would
my-
replace the theta from that, and I would go out and be doing stuff in the 60-day thing, right? Yeah, go ahead.
right, so my whole reason for bringing this up is because you were mentioning that the debit spreads give us protection to the downside and that we still have theta and whatnot. If you're closing your positions at 95 to 100% profit, you
Yeah.
don't really have anything left that you can get from those short puts.
Right.
So by doing that, this is where all of Ed's notional risk kind of conversation comes into play. By doing that, are you really providing yourself with a hedge if you still have all of the risk of those short puts on? And that's why I'm an advocate for closing stuff at 90+% profit, because you get a much greater hedge to the downside, which kind of leads into the next question I was going to ask. So I've always traded rather conservatively, and I've never had a point in time where my $100,000 portfolio is down $250,000. So how does that play out with Tastyworks or Thinkorswim when you wake up one day and all of a sudden you're down over 100%? Do they start liquidating things? Are you going to get a call in time to fix it? How aggressive do they start kind of managing stuff for you if you're that far in the hole?
So I've been in some pretty hectic scenarios. I wasn't in the flash crashes and all that, so I hadn't experienced it to that level. But what they're going to look at first is that buying power. Now, anytime that I have got a margin call, right? And I have got margin calls before. And the first time you get a margin call, you freak out and you're going, oh my God, what do I have to do? But anytime that I've done that, I've had ample time to make adjustments to the account. For example, one time I got a margin call and I'm like, whoa, this doesn't make sense. What the crap? And I got on the phone with them and they're like, it's your GTC orders. All your GTC orders are taking up buying power. I'm like, oh, dang. That's when I stopped putting on all those GTC orders, right? Because it was messing with my buying power. So, yeah, I mean, what we're going to do, we got to stabilize the buying power first. And remember, the losses that we have at that point are kind of paper losses. Now, what is a roll, though? A roll is closing something for a loss and moving it out in time. So will we experience losses? I mean, will the account be down? Yeah, we just got to keep it from being blown out. Now, have I ever gone through the 20% down in a day? All of that? No. Maybe we need to get somebody from the Thinkorswim risk team to kind of go through it with us, which would be cool, right? To get them through it and say, hey, what would we do? What would we do? We just got to survive in order to fight another day.
I wonder if maybe you have some comments, Ed, because I don't know if you've been reading the chat, Bobby, but he's kind of confirmed what my suspicion was. If your account is down 150%, they're going to start closing things out. And if they're closing things out before you have the option to buy futures contracts to kind of neutralize your delta and do these rolls and stuff, are we just going to wake up one day at zero or negative?
Well, and here's why I would say no, right? Here's why I would say no. Maybe I'm wrong. Have we gone through it? The thing is, the circuit breakers that are in place now will help to give us time, right? So that we can't go a full 20% at once, right? I mean, they will shut it down to give everybody a little bit of time to stop. Those of you that may have been in the market, back during 9/11, things of that nature, and where they actually shut the markets down for a couple of days, right? Because and you remember, then you got Warren Buffett coming out, saying, hey, don't sell, everybody hold. Y'all remember that? Because everybody was thinking there's going to be panic, there's going to be this, there's going to be that. Will we be the James Courtier, having to call mama up and say, hey, we lost everything and they're coming after us? No, maybe. I just think that overall we're going to be fine. Now, what Evan brings up here is a really strong thing, right? So if you close these, look, you're getting $35,000 worth of protection to the downside, which then protects you against some of those losses. Certainly makes sense. Now, this is even better if we bring in the volatility like we did before. Let's do that again. Right, so $34,000 of protection now becomes on a 20% down move, becomes a little more, right? 39%. Now let's go with the whole portfolio and see what it looks like. Let's now go all series and see if it'll keep those unchecked that we wanted unchecked. So let's go everything. So remember, we were down 224,000. So now we're down a much more, yeah, this keeps us in business, right? This definitely keeps us in business. So now 20% move to the downside with VIX going up to 67. We're down 78,000 on a $100,000 account. Yeah, hey, makes total sense for taking those off. I gotta say, it does. Taking the profits and letting those hedges on there for a few days. And then what do? Start paring them down in the next expiration. So very good. And it would be the future spend margin people. Yeah. Yeah. So if we could bring someone in from them, just kind of talk to us about it. Because we've been talking to them lately too about, you know, the margin with the T-bills and things of that nature. I don't know if we want to bring that up at this point or not. But here's the thing. We're talking about a 20% down move. That's kind of where I'm looking at. The broker manages things where? Do y'all know where the broker kind of manages risk on our accounts? Anybody know? Brett says net lick hits zero, they liquidate, doesn't mean the account is at zero. They start doing their little analysis right here, right at 12% down.
Yep,
This is
Bob,
where-
if you go to the, you're in the analyze tab. Okay, yeah, if
Yep.
you set it to the, you click the little down bars, set slices and do the uniform stress test. It'll give you that 12% and some other numbers. Look, I just want to jump in, and I appreciate your conversation and Evan's input here. And you know, this is kind of a gray area because there's a difference between a grind down over, say, a week or even 2 weeks of a 20%, which would be a plunge, versus we literally wake up tomorrow morning and the market is probably shut down because of something, the market hasn't even opened. So like 9/11, the market didn't open. The futures market opened for a few minutes right before the regular open, and then it closed. And I can't remember how long it was closed for 9/11, but it was closed for a while. So the odds are so microscopic of some, and then the redundancy in the setup that's happened, I'm sure, in the trading community. We're way less more electronic than we were then, as far as Wall Street, et cetera. I'm sure the redundancy is built in. So if something happened physically to, say, the New York Stock Exchange, it would not quite have the same magnitude. But we're talking, such tiny percentages. Yet, and so many people feel like this can be ignored, and many people feel like I can ignore it to some extent, but I can't ignore it fully. And I just think it is something that we need to have our eyes open for and be aware. If we are choosing to ignore it, let's at least be aware that we are choosing to ignore it with an understanding of what we're actually ignoring instead of just blowing it off. So, and that's for each one of us to decide. I mean, clearly we have a lot of stratification on the need or concern for a bombshell, or even the concern of a bombshell hedge event. So I just want to jump in there. I don't think anyone's panicking. I think those of us who are inquiring and fascinated with the Sweet Bobby hedge and other hedging type moves like Evan's talking about, and you brought up before, I think it's valid for each individual person, and therefore I think it's valid for the room to dig into.
Yeah, so we've got one Sweet Bobby hedge in, right? So we started another one. So 37.20, and this is what we do, right? We just kind of keep these things going until I level in some more. At some point, I'll check and see if we can, buy the one that's 50 points below, or you can start putting these things on diagonally. But yeah, we've got a really nice hedge in this one. So we're doing things to hedge. Now, again, what else could you do? You could do the VIX call hedge that we were doing, buying the 10 Delta VIX calls, 120 days out and doing that every 30 days, using 3% of your account per year to have that on. The problem is you could have done that in this elevated VIX and it wouldn't have helped you any in this year. Because VIX, even though it's elevated, it didn't spike up on this 20% down move this year. So we are more apt to see a 20% down move in the market, which you and I have seen this year. Let's don't play this down. The market only may be down, what, 16% year to date this year, but it was down 20%, was it not? We've already survived it. We just hadn't survived it in a day or in 2 days. We have survived a 20% to move down in the market kind of gradually. But there's been some great spikes even in this market, right? There have been some big moves to the downside. You and I handle 3% and 4% moves really well. Well, he handled those really well. So, you got to figure out what your risk tolerance is. I mean, I don't want anyone here blowing out accounts. At the same time, we can't have a riskless strategy either. You got to go in the market and take risk if you're going to get the reward. So I wish we could make it totally risk-free. All we can do is, what Evan said, hey, close these things at 10 days. If you're kind of afraid that calamity will happen in the next 10 days, it is a fabulous move. It is a fabulous move. Well, you say, Bobby, I don't know when that's going to happen. So I'm going to do that every month. I'm going to close all those shorts when they're at 95, 96%. That's great. You got to do you, because we're actually playing for something at that point that will happen 1 to 2 times, maybe in our lifetime. I get it. So let's say my $100,000 account, let's say I just keep going and we don't have calamity. And in 3 years, this $100,000 account's at $400,000, or whatever. What do you do then? You putting all of the 400,000 into the thing to potentially have that entire account, go to zero? That really crushes. That's why it's probably prudent. Take it out, put it in real estate, put it in REITs, put it in, something. Right? Put it in a mattress, put it somewhere. So you're protecting some of that capital and keep running your strategy. So at that point, you in a $400,000 account, buy the heck out of T-bills if rates are still high, and run it on keep running it on your $100,000 and making you a little bank. And the next thing you know, you got $300,000 sitting on the side to do other stuff with. Build your business, buy real estate, buy you a condo. There's all kinds of things, right? So, and that point, that's when we can start diversifying into other things. But I just can't play for the for the calamity at all times.
I have another observation here on your Sweet Bobby hedge. So I like the idea of replacing your theta. That kind of keeps things moving forward. But I guess a part of my plan is with those Sweet Bobby hedges, taking that short put off at about 90% profit. I think it kind of goes along the same thought process as taking off the original short puts. If I've collected 90% of it, yes, I'm leaving 10% on the table, but now I have 2 long puts that are even more of a hedge. And I understand why we don't want to be, super paranoid and expecting the worst all the time, because at some point there's going to be a drag on the portfolio. I'm not over here buying VIX hedges every day. I don't think that's necessary. But if we can collect 90% of our profit and then leave an awesome hedge on and then avoid blowing out our account, yeah, why not? So
prudent risk management.
that's something you could think about as well.
That's prudent risk management. Exactly.
And I mean, the reality is, if it costs me, say, 5% a year to be a little bit more conservative, is the difference between 25% and 20% a year really that big of a deal? I don't think so. I mean, we're still, like you said, way outperforming the market, doing way better than most fund managers. So adds a little layer of protection and doesn't really cost us much.
Well, and two, Evan, I mean, are we really sacrificing returns? Okay, so the really only thing you're sacrificing probably is the extra commissions, right? So, I mean, that's gonna be a little bit, but that shouldn't be 5% a year, I wouldn't think. So.
No, I was being dramatic
Yeah,
about it
yeah,
simply
sure.
because I close things out at 90%. And I like 90% because I can generally get there within about a month. So 1 month into our 2-month trade, if I can take the risk off at 90%, I've spent 50% of the time in the trade, but I've collected 90% of the profit. I'm going to leave that 10% on the table. I'm going to pay the commissions, but I'm going to take a lot of risk out of the equation. So that's kind of where I got the 5% from. But to me, I think that whatever that percentage is kind of justified if you're able to get out of the trade in half the time.
Yeah,
That's just my opinion. Ed was saying it was kind of worth discussing, so I figured I'd throw some ideas out there. I know Mark and I had a pretty good conversation on, I think it was Friday, along these lines. So people are definitely interested in figuring out how to manage risk a little bit.
I love this, right? This is where the profits are going to come, right? Regardless of where we put it. So as long as if you're taking any substantial data off, right, replace it. Just replace it. Go out and do something else. Do another 112 to replace that. And as long as you got enough gas in your tank, your returns will take care of themselves. I'm fully convinced. If you can keep this at 0.1, you're going to be just fine. Keep that at 0.1, you're going to be just fine. You don't have to have it at 0.3. Keep just enough gas in the tank. Your returns are going to be fine. Doesn't matter if it's coming at 2 days to expiration, 10 days, or 50 days. So if you're taking something off at 10 days, yeah, go out and put something else on further out. Now, that's why it was cool. Ed told us the other day, do this, right? So do another one, like it's the 6th, make your adjustments and, so pretend you got 2 6, for example, 105, 947. So what I'm doing, I'm just duplicating what today is. Then go in and make your changes, right? Close some of those. Let's do it now. You want to? Let's do it. Let's just do it. All right, we're in the IRA. All right, here we go. So let's go and let's close something. Let's take some profits. Here's our naked, right? Naked puts. Okay, here we go. So I can do them by P&L. This one is 10 days out. It is my biggest winner, right? It's 97% profit. We can close that, take risk off the table. Well, let's just look at this. Let's look at 4 of the 2800s. All right. It has $2.45 of theta, it says. But let's look at it on the thing. So it's the 2800. Or hey, I could just close 2 of them. I could close 1 of them. I could close 3 of them. I could close all 4 of them. I got all kind of options that I could do here. Let's go to the Analyze tab and let's find our 2800s. Let's go to 1 expiration. Let's just see what he looks like. All right, so let's find him. Come here, Mr. 2800. So we'll find inflation. All right, here we go. Let's find our 2800. There he is. 4 of those. Just pop him up. All right. So he's giving me $2.37 of theta. He's taking up $552.82 of buying power. Okay, let's close it. So got a big kind of spread here, right? We kind of like to get filled cheap as possible. We probably won't get filled at the 30. Let's see. Let's try it though. Shows him 30. And we'll work the trade. There we go. We did get filled 30. Dang it, I should try 25 cents. Dang it. All right, so here we go. So now let's go back. We got him closed. Now let's see what we got. Now markets have moved and done all kinds of things. So now our delta is 51 and 116. Didn't hurt our theta at all, did it? Now, of course, markets moved. 51, 116. Let's go back and put him in. 51, 116. Looks like just exactly the same. Didn't cause any problem at all. Again, markets moved. And let's see if it made any difference in our buying power. Markets moved, so that may have changed anyway before then. But let's see. So now we're at 42,925. 42,925. So it went up, right? But that's because the markets are moving and doing different things. So that's fine. So it looks like the market's probably gone down a little bit since we were talking. I don't know. My theta is still at 116. I mean, I don't even feel the need to replace the theta. Yeah, my theta's still good. My buying power went up just a little bit, right? It's relatively the same. Again, market's move. I keep saying that. So, with keeping my
Now-
theta at 116, I don't feel a need to go out and do anything.
Now at this point, if you find the debit spread that you put on with it and you look at the short put on that, you're probably at the same 95%. And you could take that off, and then you're just left with the one long put, which is probably also worth very little. So you've kind of already lost the maximum on it.
Yep.
And then you were able to take off 2 short puts, and you're a little bit more protected to the downside.
So let's go put him on. All right, so we closed the 2,800. All right, 2,800. I closed him for 30 cents, right? Correct me if I'm wrong. So that did cost me a little bit. It cost me $11.88. We closed him on 12/6/22. Let's just keep it all going here. So we made $224, y'all. Look at us. So let's make him all green. Okay, that helps us tremendously in our little statistics. But great, right? So now what Evan just said is, he said, hey, Bob, you could go to the same put debit spread, take that off, but look, it apparently, let's see if I've done anything with this put debit spread at all. Normally I put it out in the notes. No, I'm not. So what I could do is I've got one up here that I've not closed, right? PDS 4, that I could close the 33.10 on. Let's go see him, right? And just leave me with the 33.60 loan. Or I could close the 33.50 here, but probably the 33.10 is the one to close, right? It's my oldest one. So let's go look at him. 33.10. 33.10. What do you have? 33.10. So we put debit spreads 10 days out, 33.10. Here he is. Look at it. He's at 98% profit. He's giving me $1.19 in theta. Let's close him. Straight closing order. And we'll try to go down at that mid price. If we get filled there. When we're paying them, we want to be as cheap as possible. $4.97. They're not going to take it. I got all time in the world. I can work my order. I ain't in no hurry. Keep working. Come on, Bobby. Little old Bobby. I love doing this, y'all. And it's awesome that we can kind of play with this stuff. So every time I'm doing it, there we go. So we can close for 80 cents. So here's what I do on my spreadsheet then, right? Now, again, y'all ain't got to keep up with individual trades on your spreadsheet. You ain't got to. So here's what I do. I go out the side and I'll say I closed 33.10. Real easy. Close 33.10 short put at 0.80. Debit of, what's the debit? $5 and something. So that costs me $5.47. For debit of $5.47. Now, here's another thing that I do to kind of let me know that I have done that, is I'll go and grab this line to let me know something's funky here. Huh? So I'll go and I'll make him gray. Just dark enough that I can tell, yeah, something's different about him. Right? I've taken the risk off of that. So now, y'all, that leaves me with the 33.60 long put. What does he look like? Let's go find him all by himself. See what kind of protection he gives me all by his little 33.60. Give me yes. Give me a second. All for series. Here we go. And one series. High simulations, and we'll find Mr. 33.60. Let's take a moment. 33.60. Where is he? 33.60. Here he is. Ta-da! Remember, volatility, that's what he looks like. Now, remember volatility messes with him too, right? So now, if we get a 20% down move, my little put that's sitting there all by himself gives me $1,500 worth of protection. Cool. I've already taken my profit, so I've got a 10-day free hedge on. That is cool. That's really cool. Yeah, why would you not do that? Let's see what DG Smith says. Don says, my strategy is converting 4 naked puts of a 2 tranche 112. Okay, that's kind of what I did. Converted the 4 naked puts per month, convert and buying 6 puts at 1 strike. Oh, I'm gonna think about this. This is, let's pull it down when we can all read it. And buying 6 puts at 1 strike above my high strike for December. So you're converting the 4 naked puts of a 2 tranche 112 month and buying 6 puts at 1 strike above your high strike for December. I am looking to do this covering December and then closing remaining naked puts as they get to 95%. It's a modified Sweet Bobby hedge. I'm testing now, but we'll use fixed goes below 20. I give about 0.2% of my 2.5% income model. Okay, that's not bad. So your income model with doing that still gives you what, 2.3%? Hey, you can't beat that. I gotta think about exactly what you're doing, but I kind of get the gist of it. A little slow today. So, what could I do? I mean, if you want to keep this going, I mean, I could keep on doing this stuff, right? Here's what I would say. If I'm going to do this, I'm going to probably say, I'm going to beef it up every day. That'd be a cool way to do it. How about this, Evan? What if I said this? Hey, I got all this stuff at 98% profit, blah, 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 blah. Even on a big 2% down move, I'm down $3, right? This thing may be up more. You know, you could go in and then tomorrow close another one. Do the same thing.
So that is actually what I'm doing for
Yeah.
every one that I close. I'm going out and opening up a new short put. And the reasoning is if I'm taking off a 112, I'm closing out 3 short puts.
Mhm.
So like you've kind of told us, move that risk out, bring in more theta. So I close all of mine out at 90%. And for every one that I close out, I go out to the 60-day and I throw on a new short put. And then once I'm able to, then I buy the 2 long puts. And it's essentially the free hedge that we've talked about. And then I remove that short put at 90% profit as well, which leaves me with the 2 longs. So exactly what you're saying, right? Whenever you hit that 90, 95, 97%, whatever your profit target is, take it off. That's what my plan is, at least. I don't.
Now check this off. This is what's funny, right? I have taken, how many short puts have I taken off now today? Taken 5 off, right? And look, the market's moving, y'all. So now my deltas are 52, 118. I mean, it's so funny, right? I'm sitting there. So now I go, okay, now my deltas are 52, 118. And my buying power is going off, even though I'm closing all these. And again, this is based on market movement, not me closing positions. So now I'm at 43, 172. So do I have to go out and replace that data? No, 43, 272 or something. See, I'm using more buying power, even though I've closed all of those 5 puts, right? And my theta's going up. Why? Well, that's because markets move, even though I've taken off. So at this point, I look at it and I go, I don't need to go out 60 days and really do anything. Because I've not suffered, even though I've closed those 5 short puts, my theta is staying bid, right? It's just staying up there based on market movement. So I don't really feel a compulsion at this point to add more theta. And my buying power is elevated, right? Even more after I close those and based on market movement. So I don't have to do anything. And the cool thing is, sit on it and then let's go in tomorrow. And so if you want to do a hybrid version, like Evan said, and then tomorrow I come in and I go, okay, what could I close today? Let's say P&L percentage. Now here it is, 98%, 10 days out. Close him up. It's really cool that you can do this. 33.30, there he is, 98, close him out.
Yeah, it kind of seems like it goes against what your one of your more recent discoveries was, which is holding these things to expiration. But the way I look at it is at 98%, you're closing at you're not capturing 2% of it. I think that you're still catching enough of the move. You're basically capturing everything. So
Yeah.
I mean, I might be missing something. That's kind of why I bring it up in these sessions. I hope that someone can poke holes in it and tell me why this is a bad idea. But from my standpoint, it makes sense. So
You're taking off risk, right? You're taking off risk and you're beefing up your hedge. How can that be a bad thing? I don't think it can.
And that's been what I've been preaching. I think it still goes back to what I was saying a few minutes ago, and I agree 100% with this. Everyone knows that, what you guys are saying. I still think it goes back to each person's individual risk tolerance and perception of risk. Because some people might say that, well, like, Bobby, you're taking off these things at 80 cents and your long put still has 80 cents, and that's going to cost you 80 cents to hold to maturity. So it's going to And so there are pennies, you're leaving pennies, and they all add up. They do add up. But to me, risk removal and then replacing it with the other risk, as Evan's been saying, is the way to go. But that's just me. It won't be everyone. For simplicity's sake, maybe they like just, oh, my buying power is X. I'm going to let it evaporate and go to zero. I'm not even going to pull the trigger on a commission. I don't like that, but again, it goes back to people's perception of, do I even perceive that there is an actual risk? If we took a poll of the trader nerd community, probably over half the people don't really perceive a risk as real, because they feel like it might be a once in a generation thing. It's more than a once in every generation thing, because again, I'm 62 and I've experienced it. Okay, they have the circuit breakers in. The circuit breakers help a lot, but as we've discussed before, when those circuit breakers are clicking and you have people like rushing in, oh, I need to buy into this plunge. You also have people that are getting margin called out the wazoo, which forces more people into margin calls as those positions liquidate. So there's kind of a momentum issue that you have to deal with. All that being said, we could more or less withstand that. I think the real risk is something more like a natural disaster that screws up, or a major thing like a 9/11, where a physical area is getting impacted that prohibits the market from functioning properly, which again would be more difficult. So, and this is where I go back to, and I'm still working on this, so anyone wants to chime in, I'm trying to model this stuff to where I can take in X amount of premium and cover all these things. I'm already covering the exit of the naked put on the way out. So I want to sell X amount of contracts, like you were talking about yesterday, Bobby. I want to sell X amount a month of contracts to bring in, Y amount of premium, which I expect to keep a very high 90-something% after all the cost of the put debit spreads, et cetera, and removal of the naked puts is built in. So what we're looking at now, to me, as I'm trying to put this together, is how do I bring in premium to add this additional expense to the equation? And do I want to bother with that? Do I want to bother with stripping out the short put of the put debit spread, or do I want to more focus on more sweet Bobby hedges, or both? And it's a lot for me to process personally. I don't know, I'm kind of scattered right now, so I'm trying to put all these puzzle pieces together. But ideally, I would like to sell enough premium every month to have in my plan to do these proactive, preventative things that you guys are discussing in detail today. So I want to throw that out there as well, that if you're worried about blowing the 80 cents or the 30 cents or the $1.40 or whatever the cost is on the tail end and impairing your yield, your return that you think you're earning, just consider baking in the cost up front. And yes, you do have to put on higher naked put strikes to bring in the extra put premium, or you have to calendarize, you have to do something that generates the premium to cover that, or it will be creating a drag on your estimated return that you want. I'm done.
That's good though. I mean, yeah, so you gotta kind of figure out what your risk tolerance is. I closed 5 of these today. What could I do? I could, because I closed 5 of these, I could go put on a diagonal Sweet Bobby hedge. Right? I could do that. What would that look like? Well, that looks like this. Let's see what it looks like. What would it do? What do you mean the diagonal Sweet Bobby hedge? Well, I go out probably more than 60 days. Probably go, let's see what we got in 73 days here. So, yeah, here's the thing. Where would you do these, right? To start kicking in. And, probably, 16% probability of being in the money. Isn't that one standard deviation down? Is that right? So, you could sell let's just go down a little farther. Let's say we sold the 3,500 for $34. Then what would you do? Diagonal it. So you go in about 30 days. So that'd be about 43 days. 43 days. So 45 days. And let's see, I was selling that for $33.75. So what's that? 34 is 17. So I could buy 2 things for about $17. Where would that be at? Look at this. It's going to be higher than where I sold it, right? I could buy 2 of these, around here for 17. Let's see, 2 of those diagonal custom. So we go sell 1 of those, 2 of those. All right, did the whole thing for $1.75 credit. Let's see what this looks like. Let's trade. Hide positions. Only show my simulations. So I have to take this single off. Let me just get rid of that. So there's I'm selling a 3,500, but buying 2 of the 3510s. Which is right. Credit's a little more than it was. So here's what that looks like. Check this out. Ta-da! Hey, we put this thing on for a credit. It gives me $22.94 of protection of the downside in the event of the crash. What does it look like? What's it taking in buying power, and what's it giving me? All right, so here's the give me it's in the gotchas, right? It gives me a little negative delta, it gives me negative theta, and it really doesn't have any impact on buying power. So you can start putting some of these hedges in. Now what else could you do? Well, you could move that around, right? Where you got a bigger credit. So you could say, we can make this a calendar.
Before you move that too far, Bobby, if you want to just uncheck your short put, because we could kind of treat that as the same as we've kind of been talking about with our 112 short puts. Say that gets to 90% profit. Remember, you brought in $1.75 credit. So maybe you close that at your 95% profit, and now you're left with the 2 long puts, and you can see how that impacts your hedge as well before you changed it.
So let's say, my 2 long puts were at what, 35.10. Let's see what they look like by themselves. There. So those things would look like. Will it show it? No, it's not going to show it since it's a part of the whole order, I guess. That's interesting.
You might. Oh, I see. Okay.
Yeah. I could model that, but I mean, think of it. You could. There's things that you could do right here, right, to change all this. You could go, well, what happens if I go back to the 3,500? My theta was negative 306. Now my theta is only negative 288. Now I got a bigger credit coming in. Bingo. Still doesn't have an effect on my buying power.
I didn't totally understand what Evan asked, but
so
was he basically saying sell like you're talking about here, enter this trade and get a credit and get enough credit to take off the short put portion later on? Like when
correct.
Okay, thank you.
Yeah, so my intention with putting these on is to get out of the short put as quickly as I can for my 90 or 95% profit. That way you're left with the 2 longs, and it just provides even more of a downside hedge. And if you can do that all for a slight credit or break even, you're essentially getting free downside protection. So that's,
Yeah, even if I go 50 under, right, and get a big credit of 950, how's that look? I mean, these things are kind of cool, right? You still go, hey man, it still gives me $2,000 of crash protection to the downside on something that I'm getting the credit for. It's gonna rob me of $2 of my theta.
Bring your cursor to like the 3,800, the 3,900 level. I see we're going way down, but like, what does this thing do? It actually does some decent good for you.
Well, we'd have to take the volatility out, right? Because volatility is not gonna.
Yeah.
So let's just go to what the expiration looks like, 2 expirations here. So this is what it looks like. This is where you see the valley of death and all of that. So
And that's why these would need to be grouped and removed at 14 DTE.
yeah, 14
Sooner.
DT, we gotta take that. Yeah, we gotta take,
90% Evan's talking about.
Yeah.
well, so that's the thing. If you remove the short put, and that's what I was trying to model on here, you don't get that valley of death, because at that point, by the time you've hit a 90 or 95% profit target on your short put, your 2 longs are pretty much worthless. Right? So if one is fully profitable, the other is a full loss or very close to it. So at that point, by keeping those 2 those 2 long puts on, you're not really giving up anything else. And that's why I'm an advocate for taking those off and then riding the longs into expiration, because
Yes.
you keep that protection the whole time.
right. And so, what you were saying, what happens to the upside is we get to keep the credit from putting the trade on, right? We get to keep the $45. Regardless of how far the market goes up.
So can I ask another ground shaking question?
Yeah.
And it's kind of directed toward Evan, but anyone. Has anyone really studied the removal of the put debit spread and the insertion of the sweet Bobby hedge in its place? Like, don't do the put debit spread, just buy a sweet Bobby hedge to match with the naked put. Has that been contemplated anywhere out there? Because ultimately, and Bobby, you and I have had this discussion, ultimately, we really don't want the put debit spread to ever pay us any money. If we did 80 trades a year.
Yeah.
And we never had one put debit spread pay off, I would, and we all should be celebrating because we hit our target of what we're trying to achieve. And even if you're not targeting a certain premium, you're just putting these on as much as you want or can based on your metrics. Everyone wants the put debit spread, but again, as we said, unless you're slipping into the tent in the last few days or a week and a half, it's going to be a stressful situation as you're toying with the tent deal. So,
So my rebuttal to that would be that we would get some relief for our shorter or for like our smaller moves to the downside. And that's why I think it's important to have all 3 of them. Our short puts, the naked puts give us the theta. The debit spread gives us protection for a smaller move to the downside. And then the hedges would give us all of the protection to the very far downside. But if we don't have those debit spreads on and all we have is the sweet Bobby hedge and the naked, I think we're going to feel a lot more pain as far as net lick goes if we have a 5% down move.
And I agree, except I'm wondering if we don't spend the 10 points on the put debit spread and we spend it instead on a sweet Bobby hedge, we could put that hedge way up higher, right? Like, don't do it for a credit, actually bake in some points and maybe pay a $2 or $3 or $4 or even a $5 debit for the thing. Or we could even look at doing a $10 debit. I'm trying to, there are a lot of moving parts here and a lot of puzzle pieces. And it just dawned on me in the last few days, like, hey, I think eventually I might be able to put on enough sweet Bobby hedges to avoid the put debit spread altogether. Because again, I don't want to say I don't want any tent money. Of course, we all want tent money. It's like having money drop at our front door. But there is a gotcha to that money, and that is portfolio strain. And I'm wondering if there's a way just to do the naked puts and the SBHs in some mixture. So I want to throw that out for future think tank study because I think it might have some merit. In the meantime, Evan, I'm 100% with you. All of it's, in fact, right now, I view the put debit spread as more important than the Sweet Bobby hedge because it is more likely to come in play more often by far than the Sweet Bobby hedge would.
Yeah, exactly. I think we're a lot more likely to have a 5 to 10% down move over an extended period of time than just a flash crash to 20 in one day. So I like the put debit spreads, but I think you have a good point with, maybe putting on the hedge for a debit. And I mean, it seems like with our put debit spreads right now, we've kind of already accepted them as a loss. We look at our expected return on the 112 and we say, okay, we're going to keep, 40%. And the other 60% is really going towards the put debit spread. And I think we've kind of accepted the loss on that. So.
But do
And
y'all
if
kind
we're
of
gonna
agree
accept
that I think we've built something that we should, in normal markets, be able to make 20% or more a year. I really believe that. I mean, maybe I'm wrong. Maybe some crash, hurts us or whatever. But I think we can realistically do that most years pretty safely by keeping the premium in what is normally, bullish markets. We should really excel in bear markets. That's where we really should shine. And all we got to figure out is some of these hedges and like we're saying, taking off some of this risk and repositioning it further out. But I mean, it's just, I don't know, y'all. This is really strong stuff. And I know to the person who would watch this today, the first time, you're going, what in the name of God is this? This is, but we are really taking this to a deep level, diving in and getting some good information and feedback, and everything that you guys are saying, I'm taking in as well. And that's why I closed that one today. I mean, it makes sense, and the key is this. Here's the simplicity of it. Well, the devil's in the details, but the simplicity of it is this: keep enough gas in your tank. This is really the heart of everything. Keep enough gas in your tank. Don't get too far directional, right? And kind of keep your buying power in check so that you can keep enough gas in your tank. This is it. This is what we play for. We're playing for making the $116, $118 a day. That's what we're playing for. That's what we're playing for. This is really strong. Yeah, and we do have the systematic risk, Brett, because we are in the index. And I love that much more than having individual stock risk, because we don't care about Elon Musk, and we don't care about, Tim, what's his name at Apple. We don't care about those guys. We don't care about Amazon. If they blow their company up, then somebody's going to replace them. So what a great way to trade the 500 greatest companies in the United States of America. Bobby, we need international exposure. No, we don't. Because all of those companies in the SP 500 are international companies. Apple, an international company. Tesla, international company. Toyota, international company. Isn't Toyota in the SP 500? Pretty sure. Maybe it's not. I don't know. But see what I'm saying? I mean, I don't know. I think we have figured out something where we can extract money from the S&P 500 in a very targeted way. So we'll work on the risk. We'll keep working on this. I kind of like what we've kind of figured out today. Let's just kind of do a hybrid approach. Okay. So I could theoretically go in today and close everything that is at 98%. Yeah, how about let's do one a day? Give us a little activity, right? We got 10 days to go. Let's close something else tomorrow. That's kind of fun to me. Because that gives me a little action too, right? Instead of just sitting here going, I got no trade to make. Well, it is kind of cool closing something, take a little profit, And if we need to, reevaluating your theta. Did I lose $3 of theta? Well, crap, let's replace it. Let's replace that. Let's keep this built up. But let's don't replace it at 10 days. Let's replace it at 60 days. Really good stuff. You can take down your risk, but you can't remove it in a systematic risk environment. Yeah. Position sizing and hedging. Yeah, position sizing is our best hedge.